All right. Good morning, everybody. It is 11:30 a.m. Eastern Time. So I appreciate everyone joining in today for the First Look Market Alert. For those of our customers that have been around for quite some time, you may remember us doing something similar to this about 12 years ago, 11 years ago during the financial crisis. We took similar steps to help prepare our customers. And we'll be doing that throughout this current crisis that we're in as well. So I appreciate you taking time out of your day to spend some time with me to learn more about this. I value your time quite a bit, so I'm going to go through here efficiently, succinctly. If you have any questions, feel free to use the question section of the GoTo webinar. In the top right of your screen is the default where that usually pops up in the control panel. You can type in a question and we'll keep a log there and we'll reach out directly to everybody after the webinar with any questions that you have. But this is going to be a pretty comprehensive deck that I'm going to go through here. So again, we'll be looking out for those questions and answering them after. And if you want to reach out to me on anything directly as well, I'm happy to discuss this with you. So I'll get right into our webinar here. This is the First Look Market Alert COVID-19 Impact 1. And the whole purpose of this is to help you know what others don't so that you can do what others can't. This is a highly confidential deck. This is not something that we are sharing with anybody that's not a First Look customer. So this is not a public webinar. This is not something that we promoted outside of our own customers. This is only for First Look customers. Now, when we go through here, I want to make a point of a couple things. Typically, our market intelligence is accessible via our tools, so within the system. But when there are disruptive economic shocks, such as 9/11, global financial crisis, it does lead us to augment our traditional tools and provide more of a view of what's coming over the horizon. And at the end of this webinar, I'm going to show you some enhancements that we're making to the system that are going to alert you to some things on a per vehicle basis when you're pricing and appraising your vehicles to help you avoid making some potentially very costly mistakes. So I'll look forward to that at the end of this webinar here. Now, we use quite a bit of data to come up with this. We're using 20 years of retail and wholesale data to arrive at some of these forecasts: public and private supply, demand, pricing data, auction data, micro and macroeconomic data, and some proprietary analytical frameworks that are here. All of what I'm going to share with you is built based on all of that data. So if we look back to what we were able to help customers do back through 08, 09, there's a quote here that said First Look saved us millions. If you're a group, especially you've got several stores, you got a very large inventory. Looking at the data that I've looked at, the information that I'm going to share here today, if acted on, is going to help save some of you folks millions of dollars. Even if you're a single point store, this is going to help save you thousands, tens of thousands, hundreds of thousands of dollars if you act on this. I'm a pretty conservative person by nature, but looking at this data, there's some startling trends that are going to be hard to deny. And I don't like to be an alarmist or a doom and gloom person either, but the data is pretty hard to ignore here. So when we study retail, wholesale, and economic data in prior crises, it's led us to some clear lessons in what's coming next here. These shocks, and when I talk about a disruptive economic shock, there's two factors that really come into here. And it's a demand freeze, which I'm sure everyone on this call has seen to some degree. And the consumer demand has been frozen for a period of time. I live in Michigan, and in Michigan, we were pretty much shut down until pretty much this week, really, unable to sell cars at all. My brother-in-law's got a dealership. He had to close that down and hasn't been able to go in for weeks now. It's a bit extreme here. There's other states like Pennsylvania, I know, that are under similar circumstances. I've talked to at least 5 dealers a day, people at large groups, small groups across the country, and everybody's witnessing something a little bit differently. I've talked to some folks who, believe it or not, were up year over year. We're up last month because of certain circumstances. Some of the border states that were not closed down when the neighboring states were closed down, they saw business increase. But unfortunately, that's not the reality. The reality is that demand has been frozen for a period of time for most of us. And there's a sharp drop in consumer confidence right now. So not only are people concerned about their health and safety, but unemployment is at the highest we've really ever witnessed it in the country. There's underemployment, there's folks that have taken pay cuts. So there's a ton of challenges from a consumer confidence standpoint right now. And it's causing a bit of a rapid reset to a much lower level than what we experienced prior to the shock. Many of you have seen this. If you're looking at market data, if you're looking at the auctions and where some of these cars are going, I talked to a good friend of mine, a dealer down in San Antonio yesterday afternoon, and he told me, about picking up an F-150 for about $10,000 less than what he would have picked it up for 3 weeks ago. Because I think there's some folks that are really trying to move units and not a lot of folks looking right now too. So interesting factors going on right now. This auto retail ecosystem that we all live in and work in, there's going to be some impacts here, and these powerful shifts in supply and demand are going to cause those resets that I talked about, but they're not going to be fully recognized until the remarketers, until the captive finance companies, until the rental companies moving some of their inventory through off lease have a chance to run their inventory through here. So when dealers can actually retail their way out of this, and I want to really stress this, right, is to not wholesale your way out. And most folks on this phone are not trying to do that or thinking about doing that. If you can retail out of this, if you're open right now, if you're able to sell cars, whether that's remotely, whether that is, actual curbside delivery, if your showrooms are open, every state's slightly different here. If you can retail out of your inventory as aggressively as possible, as quickly as possible, you're going to avoid some substantial losses when the market actually opens up, the wholesale market opens back up, especially when we talk about 1 to 3 year old inventory. Some of these new car incentives are going to be a major factor in driving the value of those vehicles down as well. So if you can take some of the advice I'm going to provide here, I really believe not only are you going to avoid some substantial losses, but if you sell out of that inventory and hold your cash and wait until the bottom hits, the true bottom hits of this market, you have dry powder on hand, or you have cash on hand to make some buys, there's going to be some substantial profits to be had as well. Looking at some of the attendees on the phone, there's some of you that I've known for over a decade, and you remember back 08, 09 when gas prices hit $5 and trucks and SUVs, the values really dropped substantially on there. There were some buys to be made at the bottom of that market, and when things recovered, there were some folks that made quite a bit of money during that period, and we're going to see a similar scenario happen here over the next couple months. So the first insight that I want to share with everyone is that your current pre-owned inventory is going to be worth on average between $2,300 and $6,800 less per unit within 60 days of the market reopening. Now that's a big swing, and you're going to probably ask why, but it's going to make sense to a lot of you, is that on the high-end cars, you're already seeing this. On those SUVs, on those trucks, on those luxury vehicles, there's a big drop right now. So smart operators, a lot of folks that I've talked to over this last week already have said, you know what, we've already got that mentality. We don't try to hold gross on some of these expensive units. If we got to price it to move, we price it to move. And that's the advice that I would give here, is that it's going to continue to drop when this market opens back up. So be really mindful of that as you price your cars and try to retail out of them. So these incentives, again, we're seeing 0% for 84 months with a lot of manufacturers. We're seeing deferred payments in some cases for up to 6 months, many cases, 120 days. It's going to make a late model pre-owned car that may have been appealing a couple months ago far less appealing in the short term. It's going to cause some other issues in a few months, and I'll be doing another one of these webinars here over the coming weeks that we're likely going to address that issue that's going to be coming up with supply of new cars and how that affects things as well. So the first recommendation that I have is get lean fast. When the markets reopen, and if some of you are already open, retail out of your pre-owned inventory as quickly and aggressively as possible, and it's time for truly a tactical retreat. So turn that inventory as fast as possible. In some cases, I'm already seeing this, the data that I'm looking at and diving into some of your systems, I'm seeing you pricing a lot of your inventory below ACV. and you're trying to make it up in F&I. And from the conversations that I've had and the data that we've seen, F&I is really strong right now. It seems like people are concerned about the future. People are there's some fear, uncertainty, and doubt. People are thinking about, am I going to have money set aside for repair? What's going to happen in the future? So F&I is making up for a lot of these losses, and that's good news, right? Because it can mitigate things quite a bit. But if you can act quickly on here, there's going to be some folks, there's going to be a lot of competitors out there that are going to be very slow to accept this new normal, that don't want to accept the reality, that don't want to take that loss, that want to hold on to this and ride it out. And I'm generally an optimist as well, and a conservative person, and would think along the same lines. But this is going to last longer than what we would hope this is going to last, from not necessarily from a scientific standpoint, even from an economical standpoint. Purely, this is going to last longer than we'd hope. Recommendation number 2. Now, this is a very visual recommendation. It's don't try to catch a falling knife. If you can visualize a knife falling and trying to catch that with your hands, you make one mistake, it can end up pretty bad for you. It can be pretty messy. So the advice here is to be patient, to wait for the value reset to work its way through the system before you stock up, and avoid taking trade-ins in at a pre-crisis value. I've heard concerns with this with some folks that run some large groups, because it is tempting. We want to sell any car. We've got a fish on the hook, right? We want to try to sell that car if we've got somebody ready for it. But if it takes stepping up on a trade or really getting aggressive on a trade to do it, I know a lot of folks who have said, it's just flat out, it's not going to happen, because it's going to wipe out any money that you'd make on that vehicle. So really be mindful of that. And the feature that I'm going to show you at the end is going to show you how can I know possibly when the bottom is hit on this vehicle. We're taking a lot of the data that I mentioned at the beginning of this and factored it into our system, and it's going to be released here over the next couple of weeks. You're going to see actually where we predict the bottom to be on this vehicle, so that you can help avoid some mistakes like that. So just like the stock market, it's going to drop early. It's going to be easy to see some of the early drops as value and buying opportunities, but don't kid yourself. These are likely to be mirages. I almost made this mistake, and this is why I'm happy that I have a financial advisor. Is I thought I was going to get aggressive on some of these stocks, and I was going to buy, and he advised me not to do it. And I'm glad that he did, because I would have lost some money here. I could have made a little bit of money, but I would have clearly lost the money as well. So think about us kind of like a financial advisor for you in this crisis, as we're trying to help you as much as possible. We can give you the advice, you do with it what you'd like, but we're here to give you our opinion based on data, based on analysis, and it's up to you to do with it what you decide. This value must happen for the dealers and the OEM remarketers first. So we're going to see reduced consumer confidence, reduced demand. We've already seen that. That's going to continue. Off-lease inventory has got to work its way through the wholesale system, and new cars incentives have got to be priced in the 1 to 3 year old model wholesale values, and they haven't been priced in yet. We haven't seen that factor priced into these values yet. And keep in mind, we're going to see in the future as well is that when the values plummet on these off-lease vehicles, they're going to have to factor that in to the residual values on new vehicles that they may lease, and that's going to cause some changes to how aggressive things are and how appealing new car leases are in the future as well. So we're going to keep you abreast of those changes as we see those happen over the coming weeks and months as well. Third recommendation here is, after the value reset, be ready to stock up on high gross profit, high demand vehicles. So post value reset, these nearly new vehicles, especially pickups, larger SUVs, the ones that you have the most danger on right now, the ones you have the highest risk on right now of losing money, are going to become hot again. So when we look at the pre-crisis data, a 3-year-old pre-owned vehicle was trading, depending on the vehicle, was trading somewhere between 27 and 43% comparable new vehicles, MSRP. Once the dust settles, many of these 3-year-old pre-owned vehicles will likely be selling for about 50% more below the original MSRP. So you're going to see them be far more appealing again, especially if incentives change, especially if on leases the residual values change to a much more conservative model. These are going to become much more appealing vehicles again. So consumers are going to be more frugal. We know that. This is common sense, right? people are unemployed, underemployed. There's a lot of uncertainty about the future of the market. People are going to be concerned about this. So pre-owned buyers, including prime credit buyers, people who would have historically bought new, are going to be evaluating pre-owned like they haven't before. And given the low fuel prices and low interest rates, these prime credit buyers are especially likely to look at some of these previously high dollar pre-owned vehicles, the pickup trucks, the large SUVs. Insight number two, I know there's a variety of dealers on the phone. Some of you may do a healthy amount of subprime, others may do no subprime. The data that we've been looking at right now, if you guys stay abreast of the news, you probably read some of the similar trends, but the subprime market was already in a bad spot. And I've got a lot of experience in the subprime market, and I can remember this, 07 leading up into 08, 09 as well, not just with the housing market, but on the auto finance side as well. But right now, we've got millions of folks falling behind on their payments. The Fed reported 7 million consumers were delinquent on auto loans in the fourth quarter. Things were still booming. None of this was on the horizon yet. We weren't forecasting any of this yet. But delinquencies were already high. They were higher than during the height of the financial crisis, and things were pretty bad then. There was a lot of folks out of work. They were worse than that already. So we're going to see some ugliness happen in that market right now. And subprime borrowers were the heart of these delinquencies, and default rates have risen fastest amongst millennials. So we're going to see delinquency rates continue to rise. Another factor to look at is that the public markets that the subprime lenders rely on have been closed for almost a month, and they're unlikely to reopen anytime soon without any kind of government subsidy. Now, there's some hardcore subprime lenders like the Credit Acceptance, the Westlake. Those folks are very well capitalized. They only play in this market, but we've already seen some niche subprime lenders sell off their portfolios to be serviced by somebody else. If you recall, back in 2008, I can remember working at a dealership then, and we got a fax from Capital One that said, we're no longer doing auto finance in Michigan. There's a lot of folks that probably remember when Wells Fargo stopped doing auto finance as well. So we need to prepare for something similar happening again during this market. That's very likely to happen. So there's some folks that still have cash, still have capital that haven't adjusted yet. We've probably got a quarter to adjust to play in that market and take advantage of it, but it's likely not going to be there for the rest of this year. We're going to have to adjust to that, less expensive, higher interest rate subprime transaction like we saw, a decade ago. So the recommendation here is move up the market while you still can, or really prepare to adjust your inventory to cater to that more traditional subprime customer. So that's the recommendation there. Now, I wanted to provide everyone with an example of the advice that we're providing and why this makes sense. And this is a very basic example, but it's going to illustrate the point well, right? So there's two scenarios. And imagine you bought a 2018 Chevrolet Tahoe LT, right? Nice, 35,000 miles. You own it for $35,000. That's real ACV on this truck. On the top scenario in red, and you're going to hold on to this vehicle. You don't want to recognize that the market's dipping. You're going to try to hold on to it, ride out this market, and sell it once things recover, right? Being very optimistic. On the bottom, you're going to try to retail out of it now and be aggressive. And I'm going to walk through these scenarios with you. So in the top one, you held it through April, May, June. You tried to sell out of it in July. In the bottom scenario, we said, all right, we thought we could sell this for $38,000 in March. We saw the market drop quickly. We tried to get out of it aggressively, so we sold out at $33,000. We took a $2,000 loss on the front end. We made up $1,000 in F&I, so we ended up really only with, and I hate to say only because losing $1,000 on a car is never good, but we end up in this scenario only losing $1,000 on the car. May, we hold on to our cash. We're running a relatively lean supply. The market hasn't bottomed out yet, but June comes. Now the market's at the bottom. We're going to give you a notification when we feel like the bottom is really here. You buy another 2018 Tahoe. You can pick that one up for $28K. Maybe you have to put $1,000 of recon in the car. You really own it for $29,000. July comes. The market bounces back somewhat, but it's not going to rebound to where it was in March, the beginning of March or February. It comes back up, and now this Tahoe is worth a real $32,000. You can sell it for $32,000. Plus, you make $1,000 in F&I, so you make a $4,000 deal on this Tahoe now. You take your $1,000 that you lost back in April, you wash it out, you end up net with a $3,000 profit. Same scenario, if you really were optimistic, you thought the market would bounce back to fully where you think it should be. It doesn't happen. It never bottoms out. But you know what? At this point, you've had this car for 120 days in July. You need to get rid of it. The market's at $32,000. You sell that car. You finally take that $3,000 loss. Same thing. You make $1,000 in F&I. You end up losing $2,000 on that truck. And this is in a very basic, simple scenario, and it's a relatively realistic scenario here based on what we're looking at. You've got about a $5,000 swing there on the same car over the same period of time. So hopefully that illustrates the point of what the advice that we're giving here is to, as quickly and aggressively as possible, get out of this inventory, hold it, run lean, replace it at the bottom, have big margins to sell this vehicle or all these vehicles on as we recover here. Now, the last thing that I want to show you is this product preview. So this is a very familiar screen for FirstLook users. If you look at the top of this screen, hopefully you guys can see this. It's going to say COVID-19 market alert. And this is an extreme scenario. This is on a 2019 BMW X5. So it's a luxury vehicle and it's an SUV, right? Typically a relatively expensive vehicle. We're going to let you know that market prices have not yet fully corrected based on Max's market adjustment forecast. Prices are forecasted to further decrease by $3,654 or more in the coming months. Now you're going to see when there's conservative adjustments, when we feel like maybe it's only another $500 or $800, this will be yellow, not red. So you're going to see these adjustments come up, and it's an alert for you to make whatever decision you feel is the best decision for your dealership at that time. But we want to provide you with as much information, as much data as possible to help you make an educated and informed decision. If you have any questions on any of this, again, feel free to put the questions through the link there. If you have questions for me directly, I'm always happy to talk to folks. I'm always happy to engage with you. So my email is really easy. It's Cavanaugh, CAVANAUGH @maxdigital.com. Happy to discuss with you. We've got a great team of highly talented folks out in the field to service you, to help you out as well. If you need some extra help, extra guidance, we're definitely happy to help and here to serve you. So I appreciate you taking the time today to spend with me on here, and I'll be thinking about all of you through the coming months here. So thanks for taking the time.